The Bombay Stock Exchange is the historical foundation of India's capital markets. It is an established legacy institution. In the fourth quarter of FY26, the exchange generated a consolidated net profit of 797 crore rupees on revenue of 1,564 crore. That represents a 61% jump in profit and an 85% surge in revenue year over year. These growth percentages are typical of early-stage software companies, yet here they are appearing on the balance sheet of a 150-year-old financial exchange. Decoding these results requires a look at the specific business segments within the exchange's profit and loss statement. A stock exchange's revenue is not a single, uniform stream. The business is divided into departments, each with a different relationship to market activity. Operating leverage occurs when an exchange covers its high fixed costs for technology and clearing. Once that baseline is met, any additional trading volume scales margins upward because the incremental cost of processing one more trade is nearly zero. This quarter, one specific revenue stream grew fast enough to drive the total top line up by 85%. Growth was concentrated. A single business segment experienced a parabolic spike, accounting for the vast majority of the quarterly increase. Identifying this segment clarifies the underlying economics that dictated the exchange's performance this year. This bar represents the total 1,564 crore rupees in Q4 revenue. We can break this total down into three distinct segments: transaction charges, treasury, and listing services. The transaction charges segment alone accounted for 1,311 crore rupees, representing the vast majority of the quarter's income. Growth in this single unit was 114% year over year, and up 38% from the previous quarter alone. These charges are a direct mathematical output of the total volume of trades moving through the exchange's systems. Specifically, the primary driver here is the average daily turnover, or ADTO, in the equity cash segment. During the quarter, the average daily turnover reached 7,950 crore rupees. Raw transaction volume, independent of other ancillary services, provided nearly all of the exchange's top-line growth. These figures are a reflection of a broader influx of participants into the market, both in the number of people trading and the companies going public. On the left axis, we can see the scale of retail participation. BSE has now crossed the milestone of 25 crore total registered investor accounts. The rate of adoption is increasing. 3.53 crore of those accounts were added in just the last 12 months. While retail activity drives daily turnover, the primary market is where the underlying supply of equities is generated. In FY26, the BSE ranked first globally for IPO listings. The exchange hosted 255 total issues across its mainboard and SME platforms. Companies used these listings to mobilize a record 1.8 lakh crore rupees in capital. BSE's financial reporting provides a quantifiable map of how capital and participants are currently moving into the Indian equity market. However, there is friction in the business. Two of the segments we identified earlier actually saw their revenues decline. Treasury income fell 9%. A large portion is tied to fixed centers, technology upgrades, regulatory contributions, and employee benefits. The variable portion comes from clearing and settlement expenses, which scale up as trade volumes rise. While rising costs and lagging ancillary segments act as a drag, they are currently unable to offset the massive margins generated by the core transaction business. Moving from the quarterly results to the full-year figures provides a broader view of the exchange's operational efficiency. For the full financial year 2026, the BSE reported consolidated revenue of 5,148 crore rupees. Operational profit, or EBITDA, reached 3,393 crore. This results in an EBITDA margin of 48%. A 48% margin reflects the high degree of operating leverage that defines the exchange's model once a critical volume of trades is reached. This high margin performance generated significant cash flow, leading to a decision on capital allocation. The board of directors recommended a final dividend of 10 rupees per equity share for the year. This dividend represents the conversion of high margin operational growth into shareholder capital, ending a year where trading